we talked in Bitcoin going to that 110 level, gold has got the same type of scenario when we look at the overall last super cycle to the upside, the last bull market from the lows to the highs in 2011 and back down. This is the level that gold should be hitting based on its measured move. And now we're starting to see it reverse. So when you step back and look at gold from the big picture, the rally in gold to me is done for now. It's had that measured move. I believe this scenario right here is actually very similar to the scenario that we saw back in 2007, 2008. I think we're going to go into a financial crisis. Gold is going to get hit. We'll see gold down 15, 20, 25%. It is still in a strong uptrend. Don't get me wrong.
Market experts are divided on gold's trajectory, with contrasting perspectives emerging from various analysts. The precious metal has demonstrated remarkable resilience recently, rising about 1% to above $2,660 per ounce, supported by a softer US dollar and escalating geopolitical tensions. ChrisVermeulen's neutral to slightly bearish outlook on gold contrasts with these recent market movements. Vermeulen points out that gold has reached the measured move level of $2,700 to $2,800, which he has discussed for some time. This bearish outlook starkly contrasts the optimistic forecasts from major financial institutions. Goldman Sachs and UBS Group have recently released bullish projections for the yellow metal. Goldman Sachs envisions gold reaching $3,000 per ounce by December 2025, while UBS presents a similarly optimistic outlook, predicting prices to climb to $2,900 by the end of next year. Drawing parallels to the 2007 and 2008 period, he warns of a potential financial crisis that could trigger a significant sell-off in gold prices, possibly ranging from 15% to 25%. While acknowledging gold's robust long-term upward trend, Vermeulen contends that the period of easily attainable gains has ended. Historical market behavior provides valuable context for the current debate. During the Great Recession, gold demonstrated its effectiveness as a safe haven asset, with prices surging from approximately $730 in October 2008 to $1,300 by October 2010. This upward trend gained momentum during the European sovereign debt crisis of 2010 to 2012, as concerns about the Eurozone's stability and the global economy intensified. These historical patterns underscore gold's traditional role as a hedge during economic uncertainty, though investors are reminded that past performance does not guarantee future results. The current market dynamics are complex, with traditional safe haven demand driven by geopolitical tensions competing against potential economic headwinds. Before diving deep into this video, subscribe to our channel, hit the bell icon, and share.
Short-term wise, I'm neutral to kind of bearish on gold. It is kind of stuck in a short-term downtrend. It hit the measured move you and I have been talking about for a long time, which is this $2,700 to $2,800 level for gold, which once it hits that level is a measured move. Just like we talked in Bitcoin, going to that 110 level, gold has got the same type of scenario when we look at the overall last super cycle to the upside, the last bull market from the lows to the highs in 2011 and back down. This is the level that gold should be hitting based on its measured move. And now we're starting to see it reverse. So when you step back and look at gold from the big picture, the rally in gold to me is done for now. It's had that measured move. I believe this scenario right here, whoops, let me just grab a pencil. I believe this scenario right here is actually very similar to the scenario that we saw back in 2007, 2008. I think we're going to go into a financial crisis. Gold is going to get hit. We'll see gold down 15, 20, 25% and sell off. So it is still in a strong uptrend. Don't get me wrong, but I believe the measured move is here. I don't think there's a lot of upside. When we look at the daily chart, as you were just saying, David, we have seen a bout of selling hit. As soon as Trump got in, we saw a bunch of selling, lots of volume. And I think we've seen this move into people get out of boring gold and they move into small cap stocks. The Russell 2000 that day he got in, you and I were talking, the Russell was up 6% that day. I think Bitcoin was moving up. So money was coming out of boring gold, which has already hit its target. That easy money is over. Now they're moving into fresh new assets that are primed and ready and will benefit from a Bitcoin trust or a fund and tax breaks on small cap companies. So it really is just a sloshing effect. I think like I hold physical gold. I'm not looking to sell any. I'm waiting for this market to correct so I can add more for the next major leg higher. But right now I'm neutral. We've closed our gold position. We had GLD. We're out of it. We hit our target and we're done. So right now we just let the charts build out another pattern until there's another profitable looking trade set up with high probability. I still think the US dollar is the global reserve currency. When all hell breaks loose, money tends to move into the dollar. So I like the dollar index. It has a series of higher lows, a series of higher highs, a bunch of pauses and rallies. And yes, it has a little bit of it's had a rally since Trump got in. Now it's pulling back a little bit. But I do believe when chaos hits, I think we're going to eventually see the dollar push up to a buck 20. The DX futures chart here, I think we'll see it go up to maybe even 130. We're going to go way back. I believe we're kind of in a similar 2000 tech bubble phase in terms of commodities being the most undervalued in like 100 years or actually ever compared to other assets, very similar to what we saw back here in the tech bubble. So I do think we're going to see money rally into the dollar as a defensive play, which we're already seeing. We saw the same in 2008. And when we have a big rally in the dollar, it's going to put pressure on commodities. It's also going to put pressure on multinational companies. It's going to probably do a lot of damage. Other than those holding US dollars.
ChrisVermeulen emphasizes the importance of monitoring market reactions following a sell-off, mainly focusing on key assets, including gold, the dollar, utilities, small caps, and dividend stocks. He suggests that careful observation of price action will be crucial in identifying potential bearish patterns, such as bear flag formations, which could signal further market weakness. The relationship between gold and market dynamics presents an interesting case study in portfolio diversification. Gold's unique characteristics make it stand out among hedging instruments, as it tends to correlate with the stock market during risk-on periods while exhibiting inverse correlation during market stress. This dual nature becomes particularly significant in the current environment, where the Federal Reserve's aggressive stance on inflation through interest rate hikes and balance sheet reduction has created challenging market conditions. A deeper analysis of current market conditions reveals a notable disparity between headline indices and individual stock performance. While the S&P 500 shows a 7.0% decline from its all-time high, the average stock within the index has experienced a much steeper drop of over 15%. This significant divergence reinforces the old Wall Street wisdom that it's not a stock market, it's a market of stocks. Let's get back to the interview.
If we look at the last major rally up in the markets from the October low of 2022, this last move, I drew the Fibonacci extension or retracement on here, and the sweet spot for a pullback in the market is usually somewhere down between 38 and 50%. So giving back 38 to half of this rally to the upside, and based on where we are right now, we're looking at 15 to about 20% downside move for that first kind of pullback. And that is definitely a sweet spot. In fact, if we were to kind of just bring this down a little bit lower through here, it is kind of above a major support level, major pivot high from back in 2021. It's also a major pivot low. Well, there was a breakout, a pause here, which is a good sign. It means that this is a resistance area. This little pause before it could eat through this high resistance. And we have this pullback. So we could very easily see the SP 500 pull back that 15 to 20% on the first move down. And that move to me will actually be the same as this move over here, where we have this pullback. And this is where things are going to get interesting. This pullback in 2022 was a bear market. It was a very, very soft and gentle one. The damage here was bonds were going down with the stock market, which scared the heck out of people. This time around, I think this pullback could be the first leg to the downside, meaning if we go way back in time here, we could see this market eventually find some support, put in some type of bearish bear flag pattern, and then eventually break down to another level and then pick up speed. And I think things can get very, very ugly. As you know, I've been bearish for several years, but just because I'm bearish doesn't mean I'm betting on the downside. We're still long equities. But the scenario, knowing there's downside potential and knowing it could happen at any time, keeps you on edge so that you have a strategy to identify it and avoid it and profit from it. So this next pullback that you just talked about a 20%, I think is perfectly in line with the chart pattern that we're seeing here based on Fibonacci retracement and the type of volatility we have. This market has gone up so fast, it's going to come back down and have some correction. And it would be interesting to see where this Fibonacci retracement level is here. Look at that. So if we look at this rally up, it came right down into this blue box, this sweet spot here, which is that 38 to 50%. So as you just said, David, it's like perfectly in line. Expect a 15 to 20% pullback in the SP 500. The question is it just a pullback? Is it a buy the dip, or is it like, a pause before the bloodbath, like the music comes to an end, which is what I'm hinting to or thinking is going to happen. Is the music comes to an end, we go into a massive correction. It takes years to recover from. Huge opportunities, though. It's going to be pretty amazing. It'll really come down to this type of, after the market has sold off, it's going to come down to how other assets reacted. How did gold move? How did the dollar move? How did utilities move? Small caps versus dividend stocks. What type of price action does it form? Does it form a bear flag? A bear flag is the halfway move, meaning it's going to, whatever this drop was, once this bear flag ends, you're going to have the second half of that move. So we really just need to gauge and see how things are moving. And based on how things move and how the chart pattern unfolds, we can be like, okay, this is a bearish pause. This is nothing more than a bounce or a pause before we go lower. And then we take a position to profit from the collapsing price as we break down into a much bigger market, like a stage 4 decline, a multi-year sell-off. This first leg down will just be like a shot across the bow of like, this is your last chance to get out before the bottom drops and your retirement gets reset.
Gold and silver are key hedges during economic uncertainty, often decoupling from equities in volatile markets to serve as safe haven assets. Their price movements can signal deeper market corrections or opportunities, making them critical to monitor, especially as monetary conditions tighten. Their ability to diverge from risk assets underscores their value during financial stress. Do you think gold and silver will continue to rise as market uncertainty grows? Let us know your thoughts in the comments below. If you found this video helpful, like, subscribe, and hit the bell icon for future updates. Thanks for watching.